There are ways to defer taxes or possibly avoid paying them for capital gains on properties that you sell. Well, thanks for tuning in. We're going to talk about the 1031 exchange. Hi, this is Orlando Dalisay. I'm with Keller Williams Realty. I'm here with Jeff Yonamin with Exchange Resources Inc. How are you doing, Jeff?
Great, Orlando. How are you today?
Doing well. Trying to, stay healthy, trying to stay in my house. How about you?
Yes, we are in place.
All right. Well, it's good. I just wanted to give my potential buyers and sellers an insight on a 1031 exchange. Basically, for those that don't know what a 1031 exchange, it's an IRS rule that allows us to defer taxes when you sell a property. Of course, the property has to be an investment property, right, Jeff?
Correct. Yes.
Okay. So basically, it's like having a relationship with Uncle Sam. If you made him a real person, he's basically, saying, good job on selling your property. You made a lot of money. However, we're going to allow you to take the tax savings and invest it into another property. Is that a good way of saying it?
How the IRS looks at it is basically when you do the 1031 exchange, it's value to value. Okay.
Right.
So whatever you're selling for, you want to buy something equal to or more in value. So all the net proceeds from the sale, that means the down payment, the equity buildup, the gains that they made, all have to roll over to the new property. The second thing, if there's a loan on the property, the IRS says you must replace that debt with equal to or more of new debt on the new property. Or you could replace it with what? Cash, right? Like
Right.
paying off the debt.
Mm-hmm.
And then the third thing is just make sure that the title is the same way. So continuity of title is the third requirement that they're looking for, is however you hold title as a single person, as a married couple, LLC, trust, they want it to have it the same way on the new property that you buy.
Okay, so this is very exciting information for me, potentially being an investor or
Mhm.
for somebody that wants to move on into expanding their net worth. This is very interesting information because number one, they could defer taxes and then also leverage the money that they're saving. So
Definitely, yes.
yeah, so I'm gonna have Jeff explain some of the caveats to the 1031 exchange. He has gracefully created a slideshow presentation for us to review. If you guys have any questions, feel free to leave a comment below. So Jeff, I'm gonna let you take over. He's gonna share his screen right now.
Oh, thank you. So one of the biggest questions that we always get asked is, what can I buy, right? What is like-kind property? So the IRS says it's anything and everything except your primary residence. You could do a 1031 exchange to and from. So you're not stuck with the property that you have. So you have the opportunity to sell it and exchange it for an office building, multiple units, ag land, farmland, triple net properties, more rental properties, or vacant land, right? That's if it's held for productive use in a trade or business and investment purposes, you can go ahead and do vacant land too. So it's always the intent to hold which the IRS looks at. Anywhere in the United States, you could do a 1031 exchange to and from. So you're not stuck here in California. You could basically go into any of the 50 states, not the territories, all 50 states though. So that's why the benefits for the 1031 exchange is always to what? Increase your portfolio of wealth. The number one reason is because you're using tax money to what? Buy more real estate, and that
Right.
increases your wealth. So the benefit that comes along with that is what? Paying no capital gains tax. All you're going to do is defer it into the new properties that you buy. So eventually you have to pay the taxes if you sell the property and not do another 1030 exchange.
Okay. Now let's clarify that because I know questions have come up. We say defer, and then we also say pay no tax gains. So how can we avoid paying taxes at all? I mean, what are the ways?
Well, There are different strategies to do that. One of it is to exchange it. We say swap till you drop, meaning you exchange, and then die, and then you give it to your heirs, right? So the heirs should get it stepped up in basis if you plan it correctly, that they will get the properties at the fair market value at the time of death. And so if they turn around and sell it, they should have no gain because their basis as the time of death, they sell it, they should have probably a loss because of the cost. And then they could just basically have all that money available to do whatever they want to do, right?
Right.
Because
Right.
of no really capital gains, there should be actually a loss.
Now that's huge news. So for you guys watching, if you understood what he just said, he was saying that it's deferred until you drop. Now, it's very important that you structure your entity of the properties correctly, right? And of course,
correct. That's why you always talk to your CPA,
right,
financial planner, tax planner, to make sure that you have your estate plan set up to protect all the work that you have done by creating this wealth.
Now, I've had a client beginning of this year, they've inherited 5 Bay Area properties valued over $1 million each. You know, just imagine the tax savings that they would have gotten. I mean, that they have because they structured their properties correctly. Their parents did.
Mm-hmm.
And then upon their death, transferred those properties over to their name, and they were able to get a step-up basis and avoid paying capital gains tax. So again, we're going to have that topic on another seminar, and we'll discuss all of those. But be sure to consult a qualified tax consultant before making any jumps.
So true. Yes, definitely. That's one of the requirements that we always say, talk to your CPA and tax professionals to make sure that you have everything set up. So other benefits that a lot of people don't really utilize is you could do a 1031 exchange to increase cash flow, right? You could go from vacant land that's generating no cash to multi-units, commercial, anything that's going to generate some type of income on the property. You could do management relief, right? If you don't want to have your properties managed anymore and you want to do self-manage, you could basically exchange it for a triple net property, right? That basically has no management because the tenant is going to do everything, right? They're going to pay the taxes, pay the insurance, do the maintenance, and pay you rent. So that's why that's one of the benefits of a triple net property is management relief. You have very minimal management. You don't have any headaches with the tenants and the toilets and the trash of your rentals anymore. So you have that. Other ways you could do it is leverage. Like if you want to increase your wealth, right? You could sell one property and you can split the proceeds and buy 2 or 3 properties. So you're not just stuck buying 1 for 1. You could sell 1 property and buy 2 properties or buy 3 properties. And that's where the compounding effect comes into play as far as the leverage, right? You're using your cash as the down payment, and then you're getting loans to basically go ahead and complete the transaction of the other properties.
Okay, just to clarify that, let's just say you're selling a property for $600,000. You don't have to buy 1 property at $600,000 or more. You couldn't buy 2 $300,000 properties.
Exactly.
Okay. And
so
why would you want to do that from a real estate point of view? Sometimes smaller properties have a higher capitalization rate.
Basically, you diversified, right?
Right.
Went from 1 property, 1 tenant, and basically you went to 2 properties, 2 tenants. So if 1 tenant moves out, you still have income coming in from the other property.
Yes.
So you're not going to be zeroed out if your tenant moves out.
Right. Okay.
Because you have other doors that are going to be still paying you rent.
That's a good point.
And that's why people go from single family to duplex to fourplex to mini apartments, because they're looking at the doors because they go, hey, my tenant just moved out. Now I have no income, right?
Right.
For 2-3 months because I got to get the property ready. And then it becomes now income producing. But if you have a fourplex and 1 tenant moves out, not so bad, right? Because the other 3 are still generating the cash flow there to make up for the lost one.
And that's a great point because especially right now, a lot of the people are going into furloughs. They're getting,
Yes, yes.
you know, uh, temporary layoffs. Some are getting completely laid off. So these are great options to consider when investing. Good point.
And that's why you could diversify to multiple doors, or you can even consolidate. So if you're tired of having tenants and dealing and being the manager and the landlord for those properties and always getting those calls late at night, you can consolidate. You can sell 2 or 3 of your rental properties and bring them all together under one property. So that's why the triple net, where a lot of our clients are doing, selling the rentals and buying maybe a Walgreens or a Rite Aid or CVS, they're moving all that over there because those are basically your triple net properties where they don't have to worry about the management per se, because they're going to pay the property tax, insurance, and maintenance of the property.
I hope you found that information handy. Here's Jeff's information in case you need to contact him regarding your scenario. If there's any topics that you'd like to discuss or learn about, please let me know. I'd be happy to share.